Welcome to the deep dive. Today, we're really getting into the nuts and bolts of South Africa's social safety net. We're focusing on the Unemployment Insurance Act, the UIA. This is the key law behind the UIF, the Unemployment Insurance Fund. It's been updated quite a bit, especially recently, and, well, we want to make clear what it actually means for you, the person paying into it.
Absolutely. It's fundamentally about cushioning the blow of unemployment. The Act's main goal, really, is setting up the fund, making sure employers and employees contribute,
Right.
and then paying out benefits to lessen those really tough economic and social impacts when someone loses their job.
Okay, let's start right there. Who has to be part of this? Does every single person earning a salary pay in?
It covers a very wide swath, actually. Most employers, most employees. That's its strength. But there are a couple of key groups who are not covered. You need to know this.
Okay.
First, if you work for someone less than 24 hours in a whole month, it's quite minimal.
So very casual labor, perhaps?
Exactly. And the second group, well, it's the top political figures. Your members of parliament, cabinet ministers, deputy ministers, provincial council members, they're out.
Interesting. But for most people in regular jobs, private sector especially.
Oh, yes. The UIA applies directly.
Okay, so knowing who's in, let's look at the money. The Unemployment Insurance Fund itself, that must be a huge pot. Where does it all, come from?
It is huge, yes. And the main source, as you'd expect, is those mandatory contributions. They come from both employers and employees. That's handled under a linked law, the Contributions Act.
Right, the deductions we see on payslips.
Precisely. But that's not the whole picture. The fund also gets money directly from Parliament sometimes, penalties from companies that don't comply, interest earned on its investments.
Ah, so it's invested too.
Oh, yes. And even things like private donations or bequests, though that's likely a smaller part. It's designed to have multiple income streams, making it more resilient.
That mix suggests the money isn't just, sitting there waiting for claims. Is the fund's job broader than just paying out benefits?
That's a really critical point. Paying benefits is the most visible part, yes. But the Act actually mandates more. The fund must also finance schemes aimed at keeping contributors in employment.
Like preventing job losses?
Sort of, or intervening early. And just as important, helping vulnerable workers get back into the job market after a period of unemployment.
So it's got an active role, not just passive support.
Exactly. It's meant to be an active economic tool looking ahead.
Right. This is where it gets really practical for anyone listening who contributes. If you want to know what you're potentially entitled to, you need to grasp this credit system.
Absolutely. Think of it like banking safety days. The rule is quite straightforward. You earn the right to 1 day's benefit for every 4 days you work and contribute.
1 for 4. That 4-to-1 ratio is the key then.
That's the core mechanic. It directly links your work history to your potential support.
It's quite clever, like you're storing up a quarter of your work time as potential cover. Is there a limit? Can you just keep banking days forever?
No, there's a cap. And that's important for the fund's sustainability. You can accrue a maximum of 365 benefit days, so a full year based on your employment over the preceding 4-year period.
Okay, so a year's worth of cover within any 4-year window. That seems like a substantial buffer.
It is. It's designed to provide meaningful help, even during longer spells out of work.
All right, let's unpack the different situations this covers. Most people hear unemployment insurance and just think, I got laid off. But you mentioned the UIA covers more. What are the main categories?
Yes, there are 5 primary types of benefits laid out in the Act. You've got the standard unemployment benefits, naturally. Then illness benefits, maternity benefits, adoption benefits, and finally, dependents benefits.
Okay, let's take the standard unemployment one first. Are there strict rules about why you're unemployed?
Yes, very much so.
Yeah.
First off, the unemployment period usually needs to be longer than 14 days before benefits kick in. And crucially, the reason for the job loss matters. It generally have to be termination of your contract or a fixed-term contract ending and not being renewed, or dismissal, but not for misconduct on your part.
So if you're fired for cause, you likely won't get it.
Generally, no. Also covered is if your employer becomes insolvent, or, and this is quite specific but important, if your employer dies, which is often relevant for domestic workers.
Okay, so you can't just say quit your job because you fancy a change and then immediately claim UIF.
Definitely not. There are other hurdles, too. You have to register as a work seeker at a labor center. You must prove you're capable of working and available to take up suitable work if offered.
And what if you refuse a reasonable job offer?
The system has teeth there. A claims officer can actually penalize you, by suspending your benefits for, I believe it's up to 13 weeks, if you turn down suitable work without a good reason. You have to be actively trying to get back to work.
Right, it demands participation. Okay, what about illness benefits if you're too sick to work?
That kicks in if you're unable to work because of illness for more than 7 days. So a bit shorter than the unemployment waiting period.
And how does the payout work? Could someone, maybe with sick pay from their job plus the UIF benefit, actually end up earning more than if they were working?
No, the Act specifically prevents that. There's a rule, Section 21(2), that says the illness benefit plus any sick pay you get from your employer cannot be more than the normal salary you would have received if you hadn't been ill.
Ah, so it tops up, potentially, but doesn't exceed your normal earning.
Exactly. It's strictly income replacement while you recover.
Now, you mentioned family benefits. This seems to be an area where things have really changed recently, reflecting, well, modern life.
Yes, the 2018 amendments were quite significant here. They really broadened the scope beyond just traditional maternity leave.
Let's start with maternity, though. What's the standard there?
Maternity benefit is still a cornerstone. It's payable for a maximum of 17.32 weeks. And the payment rate is quite good. It's set at 66% of the contributor's earnings, subject to the overall caps we'll discuss later.
66%, okay? And the newer family benefits.
Right, this is where it gets interesting. Act 10 of 2018 brought in parental leave benefits. That's typically for the other parent, covering up to 10 consecutive days right after a child's birth.
Okay, 10 days.
Then there's adoption leave benefit. If you adopt a child under 2 years old, you can get benefits for up to 10 consecutive weeks.
10 weeks for adoption.
And finally, commissioning parental leave. This covers parents who use a surrogate mother agreement, also for up to 10 consecutive weeks.
Wow, that really does cover modern family structures much more comprehensively. It's quite a leap forward.
It is. It acknowledges different ways families are formed.
Now, here's the million-dollar question for anyone planning a family. If I take, say, my 10 weeks of adoption leave benefit, does using that benefit reduce the 365 days of unemployment credit I've banked?
That's a crucial safeguard. And the answer is no, absolutely not. Section 13, subsections 5 and 5A are very clear.
Good news, then.
Excellent news. Taking maternity, parental, adoption, or commissioning parental benefits does not reduce your accrued credit days for standard unemployment benefit. They are treated entirely separately.
That's a huge relief, I imagine, for many contributors. It means using family leave doesn't compromise your safety net if you later face job loss.
Precisely. Your main unemployment cover remains intact.
Okay, let's get into the actual money math. We know the eligibility is based on that 4-to-1 work-to-benefit day ratio. But how much do you actually get paid per day or week? It's not a flat amount, is it?
No, definitely not flat. And this is where the Act shows its sort of social equity design. It uses what's called an income replacement rate, or IRR, and it's on a sliding scale.
Sliding scale, meaning?
It's deliberately structured so that lower income contributors get a higher percentage of their previous salary replaced. The maximum replacement rate is currently set at 60%.
So the less you earn, the closer the benefit is to your old salary, percentage-wise.
Exactly. The idea is to provide a stronger safety net for those who likely have fewer savings and would face the most immediate hardship.
That makes sense socially. Is there a point where this sliding scale stops, where the percentage doesn't keep going down for higher earners?
Yes, there is. It's called the benefit transition income level. There's a specific earnings threshold.
Okay, what's that threshold currently?
As of our last check, it was $8,099 per month. Once your earnings go above that level, the sliding scale stops applying.
So if you earn more than about $8,100 a month, what happens then?
Above that point, the benefit amount becomes flat. It doesn't matter if you earn $10,000 or $50,000 a month, you receive the same fixed daily benefit amount.
And how is that fixed amount calculated?
It's calculated based on what someone earning exactly $8,099 per month would receive. Using the formula and minimal IRR of 38% at that level, it currently works out to about R101 per day.
So wait, high earners contribute based on their full salary up to a ceiling, but their actual benefit payout is capped at the level of someone earning just over $8,000 a month.
That's essentially how it works. It reinforces the social insurance aspect over pure income replacement for high earners. The system is tilted towards supporting lower and middle incomes more strongly.
Fascinating. Okay, one more benefit type. Dependents benefits. What happens if the person contributing, the breadwinner, passes away?
The system aims to provide continuity of support for the family left behind. The surviving spouse, or a life partner, or dependent children under certain conditions can claim benefits.
And what do they receive?
They basically receive the same unemployment benefit that the deceased contributor would have been entitled to if they had become unemployed instead of passing away.
So the financial support continues for the family based on the contributor's work record.
Yes, but there's a very important time limit here. The application for dependents' benefits generally needs to be made within 18 months of the contributor's death.
18 months. Is that strict?
It is the standard limit, though the commissioner does have some discretion to accept a late application if there's a really good reason, just cause shown.
Good to know. All right, shifting gears slightly. A system handling this much money and affecting so many lives needs strong governance. Who's in charge?
Well, at the top, you have the Minister of Employment and Labor. The minister appoints the Unemployment Insurance Commissioner, who is responsible for the day-to-day running of the fund and the system.
So the commissioner is like the CEO.
In a way, yes. But for broader policy and strategic direction, there's the Unemployment Insurance Board.
And what does the board do?
The board is really important. It advises the minister on policy matters related to the UIA. Crucially, it's a tripartite body.
Tripartite, meaning?
It includes representatives from government, organized labor, and organized business.
Yeah.
So all the social partners are involved.
So it's where different interests come together.
Exactly. They advise on policy, on ways to minimize unemployment, and importantly, on creating those proactive schemes we talked about earlier, the ones aimed at training or helping people back into work. It's the key forum for social dialogue on unemployment insurance.
Makes sense. Now, since this relies on contributions and payouts, protecting the fund from fraud or abuse must be a priority. How does the Act handle that?
It takes it very seriously. Chapter 8 deals with offenses. Basically, anything that causes loss or damage to the fund is an offense.
Like what specifically?
Well, outright fraud, obviously.
Yeah.
Making false statements in an application. But also things like employers making irregular payments or employees failing to notify the fund if they get reemployed while still drawing benefits. That's a common one.
Right, double dipping. And what are the consequences if someone is caught committing fraud?
The commissioner has significant power here. If someone is found to have made a false statement or submitted a fraudulent application, the commissioner can suspend their right to receive any type of UIF benefit.
For how long?
For up to 5 years.
5 years. That's a hefty penalty.
It's meant to be a strong deterrent. Messing with a fund can mean losing that safety net entirely for quite a long time.
Okay, but what if it's the other way around? What if you believe you're entitled to benefits, you apply legitimately, but your claim is denied by a claims officer? Does the applicant have any recourse?
Yes, absolutely. There's a clear appeals process laid out in Section 37.
How does that work?
Your first step, if you disagree with the claims officer's decision, is to appeal to a regional appeals committee.
Okay.
If that committee also rules against you and you still believe the decision is wrong, you can then escalate it further to the National Appeals Committee.
And is the National Appeals Committee's decision the final word?
Within the UIA system, yes. Their decision is binding. The only further step beyond that would be to take the matter for judicial review in the courts, which is a separate legal process outside the UIF structure.
Right. One last legal point before we summarize. We talked about the money paid out. Is that benefit money protected? Can, say, creditors try to seize it if the recipient owes other debts?
That's a really important protection. Section 33 is quite clear. UIA benefits generally cannot be assigned to someone else, nor can they be attached by a court order to pay off debts.
So the money is ring-fenced for its purpose.
Yes, to ensure it goes towards the recipient's basic living expenses during their time of need. There is one major exception, though.
Which is?
Court orders relating to the maintenance of dependents. So if there's a court order for child support or spousal maintenance, the UIF benefit can potentially be attached to satisfy that specific obligation. But general creditors are usually out of luck.
Okay, we've covered a lot of ground. It seems the UIA is, well, a pretty complex but ultimately comprehensive system. It's clearly evolved, adding things like parental leave, and it has that built-in fairness, especially with the sliding scale for payments favoring lower earners.
It is comprehensive. And to ensure it stays financially healthy, there's one more check and balance worth mentioning, the annual actuarial review mandated by Section 9.
An actuary reviews the fund every year.
Yes. An independent actuary has to assess the fund's financial position, looking at its assets, its liabilities, what it expects to pay out, and its overall soundness. They then make recommendations to the minister to keep the fund sustainable. That report is critical.
Which neatly brings us to our final thought for you, the listener. Thinking about that actuary's report and the fund's health, and remembering the act, allows the fund to finance schemes for keeping people employed and helping them re-enter the workforce.
Yes, Section 5D.
Exactly. How might future recommendations from the actuary, perhaps driven by economic conditions or the fund's performance, influence where the focus lies? Could we see a bigger shift down the line, moving more resources away from just passive benefit payouts towards actively funding large-scale training, reskilling, or job placement initiatives?
It's a fascinating question. The potential is certainly there in the legislation. The balance between passive support and active labor market intervention could very well shift depending on the fund's health and the perceived needs of the economy. Something to watch.